The next presentation is by Rich Mironov. Rich and I go way back, actually. We were classmates at Stanford at business school. And Rich's wife, actually, they met at business school. So that marriage was a product of our school. And then several years, I don't know, we were apart for a while, and then several years later, we were both working on corporate strategy and new ventures at Tandem for a little while. And then we've sort of split off, but we've come together at various times. Rich is really a fabulous strategist, and I can vouch for it in terms of the work I saw him do at Tandem, which was really in a very, very difficult bind as a company at the time. We were working on some of the strategy work that we did. And then he's gone on to both found some companies as well as act as a really key strategic advisor to several startups. And a lot of his focus is on the product management and the market positioning of products and of startups. So I think he has really a great deal of wisdom to impart. He's also published a book about positioning, which I think is really outstanding, and he'll speak about. And I'm also going to ask him to do a little bit of a personal introduction as part of his talk.
Thanks, Professor Zelkha. We know each other. I know Eli from, again, we were at business school in the last millennium. I'm trying to think if everybody here was born when that was going on. It doesn't matter. I put together a deck. This is, by the way, the first time I've used this deck, so you'll feel free to help me improve it, if that's the nice way to say that. Let me do the brief introduction, and I actually had a couple of these to give away. I'm a reformed engineer, right? I were one, but I aren't one now. I go to the meetings. I've been in Silicon Valley actually since before the launch of the Macintosh, for those who were old enough to know when that was. Been in a bunch of companies. The thing I've been doing since about 1996 is a series of alternating between early employee at a startup and consulting, because of course when you leave a startup, by definition you're a consultant until you get to your next startup. So, and I thought I'll go through some of those, and part of what we set up here was a sort of guess the outcome game. So I'll have the 2 slides each on a few startups and see if you can help me figure out which ones were the winners. I'm finishing a sequence right now as an interim executive at a Silicon Valley security software firm, 6 months of BR, Vice President of Product Management, because we forgot to have one and everything's broken. And I'm actually just at the early cycle of starting fundraising for a new startup that I'd be the CEO of, which you didn't know about. And so depending on how this goes, we might actually pull the back part of this deck and I'll bring up my pitch, we'll see. My sort of focus on life, and we'll have a couple slides on it, product management in the Valley is the sort of narrow group of people who straddle the technology and the business side. You've been that person, right? And we'll have a slide or two on what that is. But basically, it's somebody who has to be bilingual, who has to be deep on the engineering side, because those folks don't communicate well, but has to speak the customer language quite a bit. And so my specialty turns out to be business models. So if you had a piece of technology, how would you make money out of it, which tends to be a lost art. Pricing, and in the software world, there's a new trend called Agile, which I'm stuck in the middle of. As I said, I'm currently just starting fundraising for a new startup, which if I told you, well, we might just tell you. Tandem, where we were together, Sybase, back when databases mattered, before Oracle kicked their lights out. 5 startups. And I brought a couple of these along. Let's do this. Who in the room has the birthday closest to April 15th? Anybody closer than April 19th? All right, so copy 1 goes to you. All right, October 15th? Who's got a birthday near October 15th? September 15th. Anybody closer than a month? Anybody in October?
14th.
Okay. Sorry?
He's closer.
All right, there you go. We'll give some more away. I've been writing about technology strategy, technology product management and stuff since, again, I'll date myself here. It originally was a newsletter, started in 2001. This means it was before blogs. It's now a blog. Anyway, let me keep going. So here was my sort of theoretical agenda for the day. We'll use it or throw it away as we like. A little bit about how to think about the risk model from the entrepreneur side instead of the venture capitalist side, and I'll assume you guys are all VCs here for the moment. I stole a few thoughts from a guy named Steve Blank about what a startup is, because I think we don't think clearly about it. So try to define how you know it's a startup. A few slides on the product management problem, which is traditionally the failed opportunity for every Silicon Valley startup is it's either founded by technologists who don't know what their product's supposed to do, or it's founded by folks with a market opportunity who don't know how to build something to fill that opportunity. So the product management person is the one who sits in the middle and has the market thinking that overlaps with the technology. And then, depending on how it goes, we'll pick the winning company. So this is the 2-slide pitch on a series of companies that I was at, real ones, and we'll see if you guys can help me figure out which ones were the winning companies. Drill some questions to me, and I'll ask for votes. Does that work? Okay, good. So VCs diversify across companies, right? That's what they do. In general, they're not looking for a 40% return. Nobody cares about a 40% return. What they're looking for is a 10x return or a 50x return on a small number of their companies, because you're going to invest in 10 companies and assume that 9 fail, or 8 fail if you're really lucky. But what you need is the 10x or the 15x return on the one that significantly overshadows the other 8 or 9. So, I think if you're thinking about strategic investors from a corporate point of view, you may in fact be looking for that 40 or 80 or 200% return. But I think the VCs, at least the ones I know, aren't. They're looking for the big win, the home run, the Google, not 15 small returns. Unlike that, the entrepreneur, of course, can't do this, right? So if you're wearing and I was going to say my jeans, because I only wear slacks twice a year when people like Ellie bring me to talk. But if you're wearing my jeans, this is the world we're in, which is that you can only diversify your risk, your portfolio, over time. Because as an entrepreneur, you actually have to work at the company for a while, right? You have to say, I commit, to this company and no other, and I'm going to do that for the next 2 to 4 years. And if it's a bust, I get nothing, right? I get my salary if I have a salary. And if it's a big win, I get a big win. So pick your numbers, but you could say that, the life-changing exits 3% of the opportunities, and the war stories are 97%, and the cost of a startup is in time, not just money. And so if I think about a career as an entrepreneur, what I'm thinking about is a portfolio model of joining companies, hoping or working like mad that they be successful, and then exiting either at the appropriate time or when I've determined that they failed, because I need to move on. And here's our other thought, right? 100% of entrepreneurs know that they're in the successful 3%, right? If anybody knows the Lake Wobegon effect, right? All entrepreneurs know that they are not in this, their company is not in the 97% that will fail, okay? Clearly not true on inspection, but you're pretty much not an entrepreneur if you're trying to start a company that you think will fail. And so the risk model is one where we are all very, very sure, and it sounds obvious, but if you go to the pitch nights, everyone knows that their company will be successful. And in fact, if you sat in the room as angels, you all believed them. And mostly we're not, right? Okay, let's keep going. Here in the valley, and I'll extend the valley all the way down to Monterey, there are hundreds or thousands of startups, right? They're self-funded, they're angel-funded, they're VC-funded, they're funded by people with deep pockets who made money before. In my view, every conceivable business niche is filled with a startup or 2 or 6, right? You may have a really, really, really good idea, but you're not the only one. And therefore, and remember, most of them are going to fail, and that truly great ideas are rare. But if you're the only one in a segment, you should really wonder. And you know, like population genetics, you know, most new species fail, most you know, changes in the genome fail, but some of them succeed. It's also true, VCs like to invest in trends. Right now, by the way, it's mobile and social. We'll see in a minute, I have a mobile social startup, but I'm not with the trend. And the other is that, at least my experience with the technology community is, we all talk to each other as opposed to the world, and we all start to believe what each other say. And the ideas rattle around and ricochet around, and we are all convinced that the next big thing will be another Zynga-like Facebook-style game company, and the VCs are going to rush to fund the next 600 Zynga-style Facebook game companies, even though it should be obvious that that ship already sailed, right? It's very trendy, it's very inbred. We talk to ourselves, we don't talk to customers. I think there was something else here, right? Most fail if you adapt. Okay, so if you think of the ecosystem of startups and venture capital, the goal of the ecosystem as a whole is to fill every possible niche with a company, and some of them will succeed. That's important because if you're the entrepreneur, remember, you can't invest in all those companies, you can only invest in one of those companies, and you put your time and your soul and every minute of every day into that company. And so it's really important that yours be one of the ones that survives, even though the odds are dramatically stacked against you, right? And the VCs really don't want to have this discussion with you because they would like you to believe that your odds of success are very high, because that's their advantage. But from the entrepreneur side, we need to know that the odds of failure are high, and that we probably have to do 2 or 3 or 5 or 9 companies if we're going to have the big win sometime during the career. Let's keep going. Okay. There's a selection bias in everything you read in the business press, in every book, and every magazine, and every newspaper, which is people cover the successes, right? Everybody's heard of Google. Everybody's heard of Apple. Everybody's read the post that says our company should be like Apple and everybody should be like Steve Jobs, right? It's just wrong. There is almost no coverage of the 92,000 startups that failed last year because nobody cared about them. And so we always read about the winners. I have an old piece about burning your boats, okay? So if we go back to the 16th century, right? So Hernan Cortez and his 3 boats come over from Spain, and they land in what's now Mexico, and Cortez does what? He burns his boats. Why?
So that there's no retreat.
Right, because he knows that he's going to get twice the commitment out of his team, his soldiers, because they can't go home until they've conquered the natives and built some new boats, right? And how does the story end?
He finds gold.
He finds gold, he conquers Mexico, he kills the the folks in charge, they spread all kinds of pestilence, it's great, right? It's a win. Every Silicon Valley CEO has at some time or other said to his staff, because it's mostly men, we need more commitment from our team. The difference between us and the competition is whether we're focused. We need you all to mentally burn your boats, right? This whole trope. Anybody heard this one? Okay, so now the important thing is 35 years later, there's another guy who sails from Spain whose name is Nervez. And you've never heard of him. And he landed in what's now Florida. And he brought 3 boats full of soldiers. What happened? Anybody know? You can look him up. It turned out that the locals were better organized, and they ate them all. They got off the boats, they burnt their boats, and the natives ate them, okay? The point of the story is that we have tremendous selection bias in our classrooms, in our popular culture about how easy it is to make a company successful. And I can't stress enough how slanted that can be when it's time to face down the market and you're almost out of cash. So, burning boats is a good trope, but not always, relevant to the market. Okay, let's keep going. If I think about the VC realities from my end of this, so I'm just starting a set of pitch meetings, and I'm sitting at the other end of the table, Lark's end of the table, and I'm asking for money. And things that I think everyone in the room knows. First thing they know is that self-funding is better. If I had enough money to run this company without VCs, I would do it in a moment for all kinds of good reasons, right? The second is that the thing that matters more to the VCs than anything else at the table is whether my team and I have previously successfully brought companies out and made money for VCs. Disagree? Okay, so the numbers that you guys were all talking about before, and you were calculating a bunch of 5-year unit forecasts, they are required because the VCs need to know that you ran your numbers. They're not the first or second thing on their mind. It's, do they know the team? Has it worked together before and made money for them? This is the first order item. So, when you're in the very first pitch for the VCs, you're at a disadvantage versus other people who those VCs have made money from, because that's a pretty big bit. As a founder, I need to raise the money, and I need to raise the money faster than the VCs need to give it to me, right? There's a power shift here where it's relatively urgent for me because I have 3 engineers who have day jobs today who are going to quit their day jobs, but not until we raise money. And if we wait too long, we'll miss our market opportunity. And so I know that I have about 120 days to raise money. And the VCs know that I have 120 days to raise money. And if they wait an extra 2 weeks, they get better terms from me. And we all know that. And so the power structure is such that as an entrepreneur, I have my hat in my hand in some respects because I need the money and they have it. Next thing that's important, and this is less true than it was maybe 2 years ago, but if my VC funders put in $5 million, right? Remember our exit ratios. You as VCs need to get a 10x return on one of those companies. That requires that somehow their $5 million investment, plus a second round probably, has an exit big enough to give them a 10x return, right? If I don't have a plan to make $100 million for my company, the VCs can't get their money out in any way that matters, right? So the classic VC bet has been looking for companies with $100 million, $500 million exits, because otherwise they have to invest smaller amounts and it's kind of not worth their time. Right now we're back to the angel round. And then the last thing, and we'll say this again and feel free to disagree, there's a moment, we'll talk about it, when the VCs will replace the founders. Right? As a founder, I know this is true. So I am prepared for this, but they're never going to say it to me or anybody else until the moment comes. And if as a founder I think I'm going to take this company all the way to the end, mostly I'm wrong. So everybody at the table may know this except me. It would be really nice if I knew this also. Okay, what else? The other market realities, when you look at the market, so whenever I've written a business plan, and I've written a lot of business plans for myself, I've done about 40 consulting arrangements for startups. Okay, we've been through a lot of business plans. The business plans are always very clear and optimistic about why our selling proposition is irrefutable and correct, and the market will absorb it, right? People really do need sleep apnea metering, right? They absolutely do. My experience is that when you bring that business model in contact with the real world, you learn some things. The first is that, good or bad, your market assessment was wrong. Sometimes it's low, sometimes it's high. Mostly customers aren't waiting for your solution because they are currently solving your problem some other way. And maybe it's their spouse who elbows them 3 times a night and wakes them up. But somehow they are getting through their day without the thing you sell. And your competitive advantage is always much more obvious to you than it is to the people who haven't heard your pitch or don't care. So again, business plans are required, but often we believe them more than we should. Right? When we get out there, it turns out that, well, whatever. Okay. Therefore, really good, crisp execution and replanning matter a lot, because as soon, I'm trying to remember, Sun Tzu, right? No battle plan survives contact with the enemy, whatever, right? I don't know my Chinese. If you have a really good team, if you're light on your feet, if you have great execution skills, when it happens, and it will almost always happen, that you bring something to market which isn't quite right, the most important thing is that you recognize it and revise your plan and get back to the business of figuring out what your customers want. which is why a lot of VCs pick teams more than they pick concepts, because when it turns out the concept is wrong, you'd like the team to be able to replan. Okay, keep going. And persistence. Now there's a double bind here, of course. It's persistence if you're right. Okay, if you waste 3 more years on something that fails, it looks like you were dumb. Right? And the difference between dumb and persistent can only be determined after the fact. Right? And we'll get to that in a sec. Okay, in fact, something to think about, anybody here done this, taken statistics, right? You got type 1 and type 2 errors, right? So 2 sets of of errors. The first one, as an entrepreneur, I've talked to a lot of teams that wanted me to join. I've done a lot of, in fact, there was, I'm trying to think when it was before I joined IPASS, so this was 98. So I went for an interview with a company in San Jose, Steve Wesley, who was working there at the time, don't say the company's name, a company of about 50 people and somebody I knew there, and they needed a product manager, and I went for an interview, and I didn't do my homework, and I didn't study up on the company. I showed up. I'm smart. How hard can it be to get the job? And I completely blew the interview. And it, one of 35 interviews I did that year. Turned out that the company was called eBay. Okay? And 2 years later you say, how could you have not known it was eBay? At the time I didn't know. Type 1 errors is ignoring a great opportunity, but you don't know it's a great opportunity until later when it turns out it was a great opportunity, right? Type 2 error is joining a company that looked like a great opportunity and you wasted your time, right? Now, if we wait a little bit later, by the way, I'll dump the slides for whoever wants them in PDF. There's a later version of this too, which says, once you've joined the company, the type 1 error is staying too long and wasting your time and spending an extra 2 years someplace where you could have had another opportunity, good or bad. The type 2 error is, of course, misjudging it because you're emotional and you hate the CEO, and leaving too early and leaving half your stock on the table, and then somehow it turns around. So the uncertainty of joining the startup is the point here. Again, coming back to the point that most fail, and the only way you earn money in this game is you bet on a startup, you join the startup, or you found the startup, and you stay long enough to find out what happened. Which is why we talk about serial entrepreneurs and compulsive gamblers in kind of the same phrase. Okay, let's keep going. Here are 5 of the really good reasons to be an entrepreneur. There are more, right? The first one's in quotes because we know that 97% of them are wrong, right? I found a great market opportunity. I'm really much smarter than all the other entrepreneurs. This one's true, by the way, right? I've done them. I haven't been at a startup in 2 years, and my hands are shaking, and I need to go do it. I can't work for big companies, or I won't work for big companies. I don't know how it got there, but I just arrived. The reason, by the way, I have this picture. Let me take a side story here. I have a daughter who's now in college, and yes, I was 6 when she was born. She went to a private middle school in Mountain View called the Girls Middle School. It's a middle school for girls. One of the things they have for all of the 7th grade girls is they have an entrepreneurship course that runs all year. Not unlike the class you're in. And these girls are formed up into companies of 4. Hey, Bob. And one becomes the VP of marketing, one becomes the VP of operations, whatever. They have to write a business plan. They pitch a panel of VCs. They raise money, $100. They spend a whole year selling their product. At the end of the year, they make donations to the school, whatever. So these are 7th grade girls. That means they're 12 and 13 years old, and they are in their first startups. And I asked my daughter, stupid me, I asked my daughter, how do you know how well your company is doing and how well the other companies are doing? And she looks at me like I'm the stupidest entrepreneur in the valley, which I am. And she says, Dad, the company that makes the most money gets to keep the most money. Important lesson, really important lesson. And at 12 years old, and to come back to the previous point, so we know that at least in her age bracket, there were 40 girls in Silicon Valley that year who understood what startups were about. And they're not the only ones. Here, you know, we start early, right? Around the dinner table for our 8-year-olds, we're talking about business plans, and they're growing up early. So it's a cultural issue as much as it's anything else. Okay, so let me catch my breath here. That was the sort of entrepreneurial mindset. Interrupt for questions. Anybody? Jump in. Okay, let's keep going. This next section I've stolen, and I'll credit it in a sec. So there's a guy named Steve Blank, who, if you haven't read his books, you should buy his books. They're really very good. And he's a serial entrepreneur. Actually, that's not true. He's now a professor and a venture capitalist and angel investor. And the reason that's important is he's a former entrepreneur. The definition of a former entrepreneur is somebody who has had enough successful exits that he can become a professor and an angel investor, right? I am an entrepreneur. You can make the distinction for yourselves, right? But he draws the following distinctions between small companies, okay? There's a small business, and there are millions of them around the world, and a small business is anything a grown-up does to support their family. They run a grocery store, they run a dry cleaner, right? They run a delivery service, and they may be all of the employees or most of them. And that's a small business. Another kind of thing is the thing we call a lifestyle business. And a lifestyle business, for those of us in Silicon Valley, is a business that doesn't take that much out of us, makes us a fair amount of money, has no growth intended, but pays it spins out a good bit of cash. And the goal of a lifestyle business is not to grow the business. It's to live comfortably and have your weekends off and travel to interesting places and make charitable donations, right? The third kind of small business is the thing that Steve, and therefore I, call a scalable startup. And the scalable startup is the essential Silicon Valley startup, which is, remember what our venture capital requirements were. We're going to do something which has a small but finite chance of changing the world and making me fabulously wealthy and building a company as big as Hewlett-Packard or Google, okay? So, could become huge, probably won't, could become huge. And because we're looking for something that has leverage, that has growth, that can get big fast, it's got to have some unique solutions and some timing and some, either a technology or a market play that's defensible, right? So now we're thinking about the narrow VC-backed or angel-backed, got to get big, you know, huge rocket company. And the distinction is important here because you do a different thing, right? You work every single night and every single weekend, and you hardly ever sleep for those 3 years. Because if you're right and lucky, it does become huge, and it's a life-changing experience. And if not, there's war stories. Okay, good. So the goal of a scalable startup, what's our objective? We're actually looking for something where we don't yet know the customer and we don't yet know the features, right? So we are trying to, by definition, it's new, right? If there were other companies delivering this thing, it wouldn't be new, it wouldn't be scalable, and it wouldn't be a hit, right? I'm looking for what we would call a scalable business model because I need to know who's going to buy this, how much they're going to pay, what the distribution model is, right? But I haven't found it yet. Because if I had found it, we'd be later in the stage. And my goal is to grow out of this very early startup phase so that the rest of the story happens, right? So this is the first year before we are big enough and to the right. We are struggling to figure out who this thing is for and how much they're going to pay, and we're going to make a lot of changes along the way because our exit criteria from this stage to become a larger company is we've actually proven that there's a big market, choose your number. We've actually put ourselves on a trajectory to a lot of money. And suddenly we are going to shift from, oh my gosh, what should we be doing, to can we hire enough sales reps and can we hire more channel people and distribution and the cost of manufacturing. To come back to your other example, if no one wants the thing that Lark sells, it doesn't matter if it's 40% cheaper. Okay? If no one wants the thing that Lark sells, it doesn't matter what was on your forecast. It doesn't matter that Apple takes 30% of the cost of an application from the iStore, right? Because this is about the swing between 0 and 500x. This is about the the goal of having something which really goes up not 30% a quarter, right, but 30% a week. And they're rare, but this is the sort of essential thought process for the Silicon Valley startup. Okay, so something that Steve calls the pivot, which is the moment when I've taken my business plan, I've built my first prototype, I've gone out and talked to my first 12 customers. They all looked at me like I was an idiot, which I was. And I now have to look for another story, another application, another market segment, another pricing point, another shape or name. I have to pivot toward another market presentation because the first one didn't work. And if you're an entrepreneur at this stage, you should expect to pivot more than once, right? Your initial market concept was brilliant. It was just wrong. Your second one was also brilliant, and it happened to be wrong. Your third one might in fact be the place where you really click with customers. You start to do some trial closes where you say, well, if I really had it, would you buy it? Would you write me a purchase order now for when I deliver it, right? You trial close the solution, the positioning, the price, and because we know that the startup made a bunch of mistakes at the beginning, which we didn't anticipate, although we anticipated them, we're going to do this until we find something that works, right? Which means, again, coming back to your financial model, Lark may be far enough along that they're actually selling units. Most of the companies I've been at as employee 5 to 20, we weren't yet there. We didn't actually know. We believed, but we didn't know that the thing we had mattered. Okay, and the goal is a repeatable sales model, because as soon as we know who's going to buy it, at what price, we can engineer the margins, we can sign up the channels, whatever. Okay, let's keep going. Useful thing to know. As soon as we have a proven product concept, and we understand what its value is, and we know how to get it to market, if I'm not the guy to run that company in an operational phase, my investors will come in and invite me to be the chairman emeritus, or whatever we call it. What do we call it?
All kinds of names.
Right, ex-founder, right? As soon as we know how to run this company as a machine, hire more salespeople, drive down the cost of manufacturing, get better accounting, right? They don't need me because I was there as the idea guy at the beginning to do this trial and error process. So I should expect, unless I'm also a truly great operational manager who can grow companies from 20 people to 2,000 people, that they will bring somebody else in who's good at the 20 to 2,000 stage. So don't get too comfortable, don't unpack your boxes. Okay, let me catch my breath here. Are we okay? All right, let's keep rolling. I'm going to divert a little bit and talk just briefly about product management, because I spent, well, more years in product management than I want to talk about. Actually, the two useful facts here are, I've been in product management since 1987, and smart people don't stay in product management very long. Okay. In the typical technology company, which is a little later than the stage I drew, because it's big enough to have an organization, the product managers are the rare people who sit at the intersection of three groups, right? Anybody else besides you that's been in this job? Go ahead. Where did you do this?
Me?
Yes.
Oh, in Bangalore.
Okay. For?
Google.
Okay. It's a really hard job.
Yeah, it was.
Right. And the ratio here is probably one product manager to every 30 or 40 people in engineering.
Yes.
Okay. That's about right. So if I sort of draw this model, because it'll help us think about the startup mentality, you'd say, and I've drawn this as sort of a classic engineering input-output diagram. I say, because it was really for engineers. If I'm a product manager, what are the things I give to my engineering team? Right? I have a set of things, for instance, I call them requirements, or user stories, or market information, or roadmaps, or stuff. And it's my attempt to tell the engineering organization what I want. It almost always fails, but I try to describe my intended outcome of the engineering process. What do I get back? What's the output from engineering?
From the engineering, they just work on a drawing.
And they give you what? What comes back? What comes out?
Whether they can do it or not.
Yeah, and then? Well, in my case, since I'm a software guy, what comes out is software, right? A hardware company, whatever. I try to explain to them what I want. What I get back is software, and it's often something like what I described and rarely exactly what I described. So the next thing I do is I communicate with the folks in the sales and marketing world. What are the things I give, or I produce, or I deliver to sales and marketing? Anybody? What are the things sales and marketing want out of the engineering organization?
They want exactly what the customers want.
Sure.
But that never would happen.
I'm sorry?
The product to sell?
They want the product to sell. In particular, they want things like segmentation. Who's it for? Messages. What should we say about it? Give me the features and the benefits. Give me the pricing. Give me the demos. Right? They want all the stuff that's about selling. Right? Piece parts and data sheets and right qualification checklists. They understand there's a product in there somewhere. But what they really want is they want the operational pieces of stuff it takes to sell things, right? What do you get back from the sales and marketing world? Nothing, okay, but what else do you get back? Generally, I describe it as feedback, right? And it's almost always in the sentence of, that's not what my customers wanted, right? Regardless of what you deliver. Okay, the third one is there's a group of executives. What are the things that, as a product person or a business unit person, you give to? What's your input to the executive organization? What are executives looking for? Projections. Good. Projections. What else?
New opportunities.
Opportunities. Good. So I had a list that included strategies and forecasts and commitments and roadmaps. And by the way, that's the stuff you guys were just talking about before. Competitive intelligence. In the time frame of, we could conquer this new market segment in the next 18 to 24 months if, right? And what's the if?
We sold more.
I'm sorry?
If we sold more.
Yeah, but what's the thing we go to executives to ask for? Resources, right? So the thing that comes back from executives, if you had a good day, is budgets and staff and targets, right? By the way, as the product manager, whose budget are you pulling for? It's your product, but who gets to hire the people? The development team, right? So your job is to get resources for the people who build product, not yourself. And the target that comes back is whatever was in your forecast, right? Because you went to the executives and said, well, if you give engineering 12 more people, we can take this new market segment, which is worth $35 million. And they say, okay, here's your 12 people. When can I have my $35 million, right? This is Philips Electronics, right? You told me it was a really good segment. You told me in 2 years we can get $35 million. Okay, sign, right? What comes back now is a requirement to execute, right? This is the big company story. This is the, I'm in a company big enough to have job descriptions, right? Of course, in a startup, you don't have these nice distinctions. Let me keep going. The other part of it is, when we think about a product or a service or a proposition, we have to sort of connect the dots between three things, and you guys all know this, right? We have to actually identify a market need, right? People really do have to need it, more or less, unless it's a fashion fad kind of thing. We actually do need a way to make money on it. It's not just enough that people need it. And we need to actually be able to do the work. It's not just enough that it could make money for someone and some generic group need it. We need to connect all these three things, put our service or product or solution in the middle. Again, coming back to the point, almost every product proposition fails to connect these dots. And they can fail to connect these dots at the business plan moment. So I've, how do I say this right? I have canceled a couple of companies of mine before the funding moment happened. We wrote the product plan, we wrote the business plan, we wrote the whole thing, and we looked at it, and we looked in the mirror and said, we don't believe that we want to spend the next 4 years on this business plan because it's not good enough, right? Let's cancel it now after 1 month of work and feel lucky because we didn't do the whole 4-year thing, right? Now, maybe we made another error, but most of the business plans I've worked on won't fly. So it's iterative at the business plan level. Okay, let's keep going. Other thing to point out, right? Markets are complicated, markets are complex. The only way you can find out what's out there is you go out and you talk to people who you think would buy this stuff, right? If it's sleep apnea, go out and find 20 people who have sleep apnea and ask them how bad a problem it is, right? It seems obvious. Almost every entrepreneur I sit down with has not done this. They sat in their offices, they had some technologists, the CTO said it was going to be great, right? What they didn't do, right? And so they couldn't ask these kinds of questions. Right, well, what's the pattern? Who are the outliers? What does my typical customer look like? And does this person or company fit the model, right? Everybody has existing solutions. Where would my thing go, right? The new up-and-coming all-electric cars. The Nissan Leaf is going to be out next month. Is that right?
In select markets.
Okay. The number one issue they're going to have in California is?
Infrastructure.
More specifically?
Charging stations.
Right. There aren't charging stations. Okay. So everyone who buys a Nissan Leaf needs to put a charging station in their house. And they need to work for a company that has a charging station or put one in, right? We all know this, but most products come to market without anybody thinking about the deficiencies in the infrastructure, right? Let's keep going. All right. My rule of thumb, which means it doesn't mean anything, is if you need between 8 and 20 interviews with people who you think want to buy your thing before you see the pattern. By the way, if you get to 20 and there's no pattern, look for something else, right? And your initial theory is always wrong. It's not always wrong, but it's almost always wrong. And so if you don't do this, you've wasted a cycle, right? And we know that agility is really important. All right, let's keep going. Anybody know about this distinction, right? It's old sales 101, okay? The other thing that entrepreneurs do relentlessly is they pitch their product, right? And so I said you had to go talk to 8 to 20 people, right? And so my entrepreneur, might be me, might be somebody else, sits down with a potential client and says, and talks for 20 minutes about this solution, right? Fail. Because as soon as I'm pitching, my conversation partner is being sold to, right? And we all know how we feel when somebody sells us something. We get defensive, we hide the facts, we're unwilling to share, right? If you want to learn something, you want to be listening instead of selling. And the hints here are, you're selling when any of the following are true, right? You're talking, you're anticipating the objections that are going to come from the person you're talking to. Well, okay, he's going to tell me that he can't afford it, and I'm going to come back with a lease-back program, right? You've got your arguments lined up. You've got a goal, you're going to get him to the next stage. You're selling, right? Which is really important if you should be selling because you have something to sell. If you're trying to learn something from your prospects, you want to be doing the opposite, which is, tell me about your problem. What happens when you can't sleep at night because your spouse has sleep apnea, right? Gee, what did you do to fix it, right? How much did you spend on that? How much better would you feel if you had a good night's sleep, right? Well, did you guys buy baby monitors, right? Talk. Question. Shut up. Right? Because the person you're talking to is going to tell you things that you need to know. Right? And if you don't shut up and find out what they are, then you don't know them. Right? It seems obvious. Almost every entrepreneur I've sat down with loves his or her product and pitches. Right? Okay, good. Let's keep going. There's one other thing that you probably need to know how to do, and I'm a B2B infrastructure network guy, so I apologize. If you're selling something to people who are going to justify the cost, it's a business expenditure, it's a corporate IT thing, they're going to go through an exercise that looks like this. I'll walk us through it. And you have to therefore be able to do it for them because they're lazy. Okay, so I invented a company here, I'll just tell you the background, which is this company makes databases for tech support people that are somehow smarter and better, and the tech support folks can answer questions faster. Okay, that's my company, that's what we sell. And I'm going to go to big companies that have support engineers, and I'm going to say, buy my thing because it will make your folks on the phone answer questions faster and save you money, right? And they all say, well, how much money will it save me, right? Huh? Well, if you can't do the following math, and again, it's fake, but you say, well, your company gets 22,000 calls a year, and your folks average 6 minutes a call, so you spend 58,000 hours answering calls. And that means you have a team of 3 people, and they cost you this and that and that. And we can save you 20% because our thing is miraculous. And that's worth $51,000, right? By the way, we don't want 51,000, we only want 10. But I can show you, the customer, why you will save $51,000. And if I can't show you that, you have neither the time or the interest to go figure it out for yourself. Right? Now, this math is fake, but for your product, if you're trying to save people money or make people money, and you can't do this math, you can't sell your product. And this required me to know an awful lot about my customer, which is why it was important that I be listening. Right? Listen, 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 because if I can't tell the story for how my customers are going to save money, then I can't justify the expense. Okay, let's keep going. The last thing, and we're going to do maybe 2 of these, and I'm done when? Okay, good. So this is a game called Pick the Winning Company, and the company Bob and I are at is not shown here. And the goal here is I have some slides on a series of startups, and I have the one slide which is the basic proposition, and the one slide which is the architecture slide. You guys get to ask me some questions, and then we're going to reveal what happened. Okay, so for me, I spent 15 years with big companies, including these guys at Tandem, 8 years with startups, and 7 years consulting. So that's a lot of years. The challenge is either when you're pitching the company or you're being pitched as an employee, there's very little information. There is what there is. We all know around the table that the numbers are fake. The team had to put numbers together for the venture capitalists, but they were fake. And so I've got to decide whether I'm going to join this company on very little data. So let's do one. All right. I joined a company in 1996 called Wayfarer Communications. Let me set the stage for you. This was early in the first days of the first browser war. Most of you hadn't opened a browser yet. But Netscape, if anybody remembered Netscape, had 80% of the browser market, and Microsoft had just shipped the first version of IE. They didn't have to call it IE1 because it was just IE, right? And my company had this thing which would pop a browser window up on your corporate laptop thing, right? So you're sitting at your desk in your corporate office and would pop up a browser and it said, alert, something happened. For instance, if I'm a corporate application owner, I can signal, please pop a browser window up on the desks of the people in the manufacturing operation when we have less than 300 wingnuts left because somebody better order something, okay? Pop a browser window when my biggest customer goes on credit hold. I can tell the folks in order entry not to accept orders. Pop a browser window and tell me when something happens, right? You guys make some sense? It was licensed software, and we started selling it direct to big companies that had big databases and big applications in their offices. Make sense? Okay. Every technology company has an architecture slide. They all look like this. So what would happen would be something would happen in the company's applications, their order processing application, their factory application. It would pop over to the database, and the database would say, I need to alert Larry and Sue and Peter in these departments. It would send a message to their PCs, and it would pop up their Netscape navigators, because that's all there was, with a little message that said, Peter, you need to be alerted when any one of the top 10 customers went on credit hold. That's what we had. Okay, so now we stop. So I had a chance to join this company, and now all you guys have a chance to join this company. It has 10 employees. What are the questions you would ask? And then we're going to ask for whether you are going to join the company or not.
This is just coming from someone of the age of Oracle and SAP.
Right?
I don't. It's hard for me to put this in context.
Understand.
It's kind of before my time. What is the value added in this product back in this time did some clerk not call the right person and
Right.
say, we're out of X wing nut?
So the issue was that this is early in the days of application servers. This is before Oracle and Sybase made it big. So what would happen is a customer would go over the 30-day late payment threshold, and somebody in an order entry would have it on their desk in a paper stack in a report, but the folks in sales didn't know, and so they would take more orders from the customer who was on credit hold. Likewise, the folks on the factory floor were running short of some critical part, but the person in supply chain didn't know and didn't pick up the phone and call the people who could get the 4-hour special delivery of wing nuts, and the factory floor would turn off, would stop, because we were out of something, because application automation hadn't happened enough yet. So this was a human-assisted alert that said something important happened, do whatever it is that you're going to do when that important thing happens. Anybody? We're going to ask you guys whether you're going to join the company. Go ahead.
I'm just trying to understand how it works on the other end. Because I'm an employee, that's fine enough, but on the other end, in the factory, do they have to go to the computer and type in translate and press enter?
No. So the database knows, but the question you didn't ask, which I'll answer anyway, is if you're not sitting in front of your computer.
I'm talking about
Yeah. So this assumes there's some system that knows it's out of wing nuts.
Okay.
Some system that knows you didn't pay your bill, but that the people who need to know didn't know. And if they're sitting in front of their computers with their browsers open, it would tell them. Okay, what else? Anybody?
Doesn't this mean though that they have to be sitting in front of their computer all day if they need to know something? Does it come to your beeper or to your cell phone?
So it does mean that. So it only means you have to be in front of your computer when something important is going to happen. But since you don't know when it's going to happen, it would be better if you were at your computer all day long. We could, actually this is sort of early in the cell phone days. Later on we could have kicked off a cell phone, but cell phones, if we go back to 96, cell phones were still 4.5 pounds, right? They had a 1-hour charge, and you had to stand and point it toward the right satellite, right? I mean, it was early days. So Blackberries didn't exist yet, but would have been good. Okay, anybody else before we take a poll here? Because this is about as much time as you're going to get before we ask you to join the company. Go ahead.
So if somebody's going to be monitoring this at their workstation all day or whenever something big is happening, that would, just the thing about this is that would require somebody just to sit in front of it and sit in front of the computer, and I'm trying to think what else could they be doing.
Sure.
So,
Well, let me give you the other example. So I'm in the accounts payable department, or I'm in the sales operations department. There's 6 people who process order entry. In the course of the day, almost all of us are at our computers processing orders all day long. We don't go anywhere. We sit in front of those computers. And it might pop this up on all 6 of our desks. And somebody would say, oh, GM has just declared bankruptcy again. Let's not take any more orders from GM, right? So there are typically lots of jobs where people sit at their desks all day, and you should hope to never have one.
So if it pops up to several people, does someone take care of the problem? Will they be able to send a message to take care of it?
So it's up to the people who get it to figure out how to take care of it. So this is just the wave of the flag that says, I've told everybody in order entry not to accept orders from General Motors, and I hope they saw it.
And so 20 people get it.
20 people get it.
You can have the risk of 20 people taking care of it.
Yep.
Okay.
Yep. One more.
It seems like we should have some sort of relay system back that says, yes, confirm, someone read this and someone's doing something about it.
Would be really good.
Otherwise, your top managers are just going to be like, oh, hey, did you get, I sent the message
Sure.
out and there's no
Good.
response.
Okay, so we need a show of hands. Choice 1, you join this company, you're employee number 11, you get 3.5% of the company's stock, and you hope for something big. And choice 2 is you pass, and you hope that 18 years later you're not telling the eBay interview story.
Yeah.
Show of hands, who's going to join the company?
yeah, okay, I'll join.
1. Anybody? Ellie's going to join 2, 3, 4. Okay, so let's just keep rolling. What was the outcome? So I was there about 2 years. We had what in the industry we call a rescue acquisition. A rescue acquisition means nobody made any money on it, but we transferred the assets to another company that thought they might want to use them. So our stock wasn't worth anything, but it wasn't down in flames. It was this sort of gentle exit. I got nothing out of that. The core issue for the company was, it was a technology story. It was not a solution. In order for you to make any use out of it, you had to figure out what you were going to do with it, tie it into your database system, figure out whose desks they were going to pop up on, make sure they were sitting there when it was supposed to happen, and decide what the feedback process was so that not everybody tripped over each other. It was a really interesting concept. It was driven initially by a CTO who said, I know how to pop up browser windows. I wonder what we can do with that, right? It created a lot of work on behalf of the customers. They had to do a lot of stuff. It was hard. And it turned out then, and by the way, it's still true, that sending an email was frankly just as easy and had a traceability, right? Didn't go away. And so then and now, when something bad happens in your office, systems send out emails that say your server's down or your credit rating's changed, whatever. Email's the way to do this. So not terrible, but mostly a waste of time. All right, everybody know how we're going to run this now? We'll do one more. Okay, this next one, a company called IPASS. Anybody heard of IPASS? Probably not. Okay, thanks. We're going to go way back in the sands of time still. This is 1998. Before broadband, before 3G, before hotels had internet access. And the way you got, anybody remember, the way you got on the internet in 1998 was 14.4. You put the phone line in the jack in your laptop, and you dialed the number, which was called a dial-up number, that was run by an organization called an ISP, or Internet Service Provider. And you typed in a username and password, and you heard all these little beeps and bongs, boop, 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 and then it put you on the net at, on a good day, 14.4, right? We created this thing which we called a clearinghouse, which meant we signed up dial-up providers around the world, so that if you were someplace where your dial-up provider didn't have a number, you could use somebody else's dial-up number, right? And so the user stories, and these all have user stories, you'd say, well, I'm an internet user, I'm a dial-up user, I'm going to be in some other country next week, right? I'm from Argentina, I'm going to be in Milan, I'm from Italy, I'm going to be in Canada, and I can't get on the net in Canada because I don't have a dial-up number in Canada, right? And I need to get my email. And it was set up as a transaction price service, so you only pay for it when you use it. And initially to be sold through the dial-up providers, so they could say, well, we only have dial-up numbers in Canada, but if you happen to be traveling to Santiago, Chile, here's how you get on the net. Okay, there's the proposition. What's the other thing we need to show you? Architecture, right? Every technology has an architecture time. Okay, so here it is. By the way, as we go through time, the pictures get better because art's better. Okay, you're here. You're in, Stockholm. You are actually from Chicago. You're not from Stockholm. You dial up a number there in Stockholm. It says, well, we don't know who that is. They pass it to the IPASS Transaction Center, which passes it back to your internet service provider in Chicago, who says, yes, I know who they are. And you're on the net, you can get your email. Okay, so there's your proposition. What would you guys ask me before you decide if you want to join this company?
Am I taking the long distance service?
You're not, because this is a local call. Okay, so if you called from Stockholm to Chicago, what would that call cost you? Okay, but you're calling Stockholm to Stockholm. Anybody?
How do I get my number?
So initially, you have to sign up with your internet service provider, who gives you this piece of software you put on your laptop that has all the numbers in it. Because of course, you can't get online to pick up the number because you're not online, because you need the number to get online. So you have to have basically a phone book on your laptop before you can use the service, because you're not to the cloud yet. Anybody?
How many ISPs you guys signed up already?
At the point I talked to, and by the way, I joined all these companies, so it doesn't matter. About 110 ISPs representing, let's say, 13 countries, 14 countries.
When you get your ISP, is it like an additional add-on?
Yep. It would look a lot like your cell phone bill, where it said, $9.95 a month for your service, 6 minutes in Stockholm at 20 cents a minute, $1.20. And the ISP gets about a third of that revenue to keep. Anybody? We ready to go? Okay, so you have your 1 hour interview. It's time to decide if you're going to join this company. Who's going to join the company? About half. Okay, good. All right. Outcome. Actually, I'm going to take a side route. This chart is actually a chart that's stolen from another industry. Okay, you know what industry, right? No, anybody? The way credit cards work in the real world is the following. I have a credit card that I got from Wells Fargo, and I walk into a store that clears their credit card stuff through Bank of America. And what happens, I swipe my card, and the merchant's little terminal says, well, you're not a Bank of America customer. We're going to send your information to Visa or MasterCard, and they're going to send it to Wells Fargo, and Wells Fargo is going to tell me whether that account is good, and they're going to tell Visa, and then they're going to tell the merchant, and they're going to accept my credit card, right? We call this a clearinghouse, right? Turns out the reason MasterCard exists is because Visa needed a second competitor, or it would be a monopoly. This is a hugely profitable market, right? Billions of dollars. They take 2% every time you swipe your card. At IPASS, we copied this from this because we knew that if we were the only folks with a clearinghouse, we would make a lot of money, and we did. IPO in 2003, originally scheduled for 2001. Anybody who was in the market in 2001 knows that there were no IPOs in 2001. $1 billion cap. The killer application turned out not to be the people we thought. It turned out to be employees of large corporations whose time was valuable, who needed to check their email every single day and were traveling across national boundaries. We call them road warriors. Lawyers, consultants, M&A specialists, right? And by the way, it turned out that while price was important, the thing that was really important to these very expensive people was that it worked and it had high quality. And if we go back to our example, the number you called in Stockholm had a much better quality and higher bit rate than calling across the world to Chicago. And so, yes, we saved the company 98% of the cost, and the ROI therefore was almost 100x. But the reason people used it was because the lawyers and M&A specialists, go ahead.
Just wanted a quick question. I thought that was your target market.
Well, so initially we were trying to sell to internet service providers. And what it turned out was they just didn't care. We ended up going directly to big companies. We went to SAP. We went to General Motors. We went to McKinsey and Company. We said, we can save you $15 or $40 million a year, but the reason you want our product is because you're very high-priced consultants will yell at you less because they can't get their email when they're visiting in Santiago or Buenos Aires, right? We didn't see the market, but the market found us. They told us, right? So changed the channel, changed the target. The technology was right. Good money, good outcome. All right? Want to play one more? Okay, so it's languished after. So it was a model built on dial-up. Anybody still using dial-up? Not in this country, not in most countries. Today, road warriors go to hotels, and there's only two choices. The high-speed broadband in the room is free. The high-speed broadband in the room is not free, but it goes on your hotel bill, and nobody cares, right? So the initial market for this has gone away, except in parts of the world that still use dial-up. And the company has really struggled to find additional services to replace the fact that dial-up doesn't matter anymore, and that broadband is a different business model. And so they've been taken private. There's Shamrock Investments, which is the Roy Disney family, and they're wandering. But
to stay consistent with the story you were telling earlier, you got to choose the winning company, but then, and it's got to have a big success. But then you've got to have a right to sell your stake as well before it's over.
Good.
Was that opportunity then?
Well, yes, not the way you might have expected. So here's where I say I would have loved to be really smart and stayed with the company long enough to vest all my shares. The founding CEO, who I thought was godlike, and I would have followed through any desert with no water, was replaced by the board with somebody who I felt was completely incompetent. And so I left, which was an emotional decision, and I left about half my shares on the floor to go to the next company you're going to see. Had I stayed longer, I would have gotten more out of it. They've been through, I think, 4 or 5 CEOs since then, so it's been churned. But I wasn't thinking about the type 1, type 2 error of leaving too early. I was thinking from here instead of from here, and was very, I was a huge fan of the founding CEO, and when they replaced him, I felt like that was a personal affront to me.
You guys were not in lockup at that point?
I actually left before the IPO. So I wrote a lot of the text for the original S1 filing, and we filed that in December of 2000, just as the market was falling apart. So we were gonna come out in March of 2001, but no, in 2001 the whole IPO market fell apart. So I wasn't still there in 2003. I had taken my half of the shares and left. So I got to celebrate the IPO from the outside. Although, one other note and then I'll let it go. So you and I have a lot of classmates who are other VCs, right? I gained a whole bunch of IQ points the month that this company went public because I had been there and had shares in a public company. Whether I was smarter or not on that day is, good. All right, let's keep going. Let's do one more. Okay, good. So next company, it's called, and it really is called Slam Dunk Networks. And here was the proposition. By the way, these are all sort of geeky networking B2B things. I apologize, that's who I am. So here's the context, 2001. So this is the company I left IPASS to go to. Proposition, companies were having this huge explosion of company-to-company communications of business paperwork. You send purchase orders here, you send cancellations there, you send invoices here, you do it electronically, you do it over the net, and there's a big worry that maybe they don't all get there. How do you know, you, Big Corp, that the invoices and purchase orders you're sending to all of your supply chain partners got there? And so we built a service, and by the way, I'll show you the architecture diagram in a sec, that we thought of as the FedEx for purchase orders. So your big corporate system that sits in the back in the big glass house where no people are is issuing purchase orders and invoices and credits and all the stuff that systems do, and we're going to make sure that all those get to the right trading partners. So the user story, because we all want a user story, as a company with a corporate application, I need to make sure that my supply chain partners get all the paperwork I send. Faxes are easily lost, phone calls are mistranscribed. I need to get all the paperwork to all of my trading partners, right? Software as a service, and we put a sales force together to call on big companies to sell them this. Everybody understand? Okay, does it need an architecture picture? Yeah. Much better architecture picture, right? The trend over time. So here's the customer's application. They put a transaction in here. And we had this thing called a connector, which would create multiple copies of your invoice. 2001, there were still a lot of US carriers and the internet wasn't that stable. So we would send one copy of your invoice to a server that was on the Sprint network, and another copy of your invoice to a server that was on the AT&T or the MCI network, maybe 3. And they'd all go to your supplying customer here. And whichever one got first got delivered, and we'd throw all the other ones away. So even if the entire Sprint network in the entire continental US went down, your invoice would still be delivered over the AT&T network. Okay? Making sense? All right, here's our story. You just had your interview. It's time to decide, ask some questions. Are you going to join this company?
Who else does this?
So there's no one else who's doing this. There's a previous set of technologies they call VANs, value-added networks.
How did they do?
It's sort of store and forward. You put a message in, it churns around and sort of works its way through. Anybody?
Is it really that unreliable to send it by email?
I'm sorry, say again?
Is it really that unreliable to send it by email?
Good question. I don't know. Actually, the CEO convinced me that it was. that this is a big issue.
Yeah, what are failure rates in companies for not receiving orders?
Hard to tell because mostly when they don't arrive, you have a sort of a phone transaction and people yell at each other and they fax stuff in the back. So there's not good tracking of failure rates and costs here because it's people who get around the system.
What was the transaction price?
We actually did this on a cents per transaction. It was like a quarter of a penny per thing.
Doesn't email already do this?
I'm sorry, doesn't who?
Doesn't email already do this?
So mostly people don't send invoices by email because it's not, email's not a guarantee. It's not guaranteed time delivery, and things sort of stack up in boxes. Email's how you send consumers their monthly bills, but it's not how businesses send bills to each other.
And it's secure.
And it's very, 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 very secure. We have like 6 people on staff who are top crypto people, and you would know who they were if you cared. Okay, time's up. I joined this company. Who's going to join this company? Not quite half. One more fact. I forgot a fact. The company has, at this point, before I've joined, raised $70 million in venture money with top-name venture firms. And the CEO's brought 3, the CEO's the founding CEO of MIPS, and he's brought 3 or 4 companies out public. Show of hands? About half, okay. All right, high concept. Raised just before the 2001 bubble. To the nearest $1 million, the company earned no money. Actually, more specifically, to the nearest $10, the company earned no money, okay? There was no money in this. It turned out that there were plenty of ways to do this. The existing value-add networks were just fine. The customers had no need. By the way, the internet has something called retransmitting. If you send a packet and it doesn't get there, it sends it again. The symptom, and for any of you who see this, you'll know, I was there 9 months, which isn't a long time. I saw 3 complete sales forces come and go in 9 months, and it went like this. My first month, the CEO called the VP of sales in, who had 12 sales reps working for him. CEO, 12 sales, that's 13 people. And he said, okay, VP of sales, how many deals have you closed? And the VP of sales said, 0. And so he fired the VP of sales, and he fired all 12 sales reps because they weren't doing their job. And he hired a new VP of sales and 12 new sales reps. Okay? 7 months later, we had this meeting where the VP of sales came in, and the CEO said, how many deals have you closed? And he said,
0.
And so the CEO did what? And?
Hired a new army of...
Now, you could say that you were just unlucky and you got the 2 worst VPs of sales in the valley and the 12 worst reps on the planet, and it was a sales issue. Or you might have come to a different conclusion, which is maybe there's a product issue and you need to pivot, right? At that moment, I decided it was time to leave because, well, if we couldn't sell anything, it was just not going to be worth its time, right? And so the outcome of this, actually, it was 4 or 5 years of sort of lingering IP, but there was never, you know, it's a matter of pride that I was at a company that raised and spent $70 million and got essentially nothing for it, right? And so you write this one off as time spent, but if we come back to our type 1, type 2 errors, so I left at the 9-month mark, so I consider it a success for myself, because I could have spent 2 more years there, right? Dreaming the dream, hoping the hope, because it was clear to me that I was at a place that I could leave with no ill effects, right? So anyway, there's some slides we don't need, but let me sort of wrap up and then ask for questions. What I'm trying to paint here is, from the VC side, you're looking at business plans, and some of them are actually quite sophisticated and good. The concern from the VC side, of course, is that in general, the market information is weak and poor, and the entrepreneurs may not have done a good job of figuring out what the market wants, but you have to decide whether to invest. From the entrepreneur side, you're much earlier than that, and you have to decide if this is a proposition that you're going to throw your heart and soul into with much less information than even the VCs are going to get at the pitch stage. So I'm out pitching a company, and I know that my numbers aren't very good. And by the way, so do the VCs. But I've already had to sign up to present those numbers, because otherwise it never happens. And if the VCs say yes and fund us, then I'm pretty much obligated to stay with this company until they decide they're going to replace me. Right? So I'm having to make early stage choices with limited information, I think is what the economists call it, right? But imperfect information. The alternative is for me to wait until I see which companies are successful, join them at a stage where they're already successful, be an operating manager at a company that has already made most of its stock grants, has already found success, and then I become an operational manager who is operationally successful at driving growth and process, which is an honorable thing to do and what almost everybody in the Valley does and I love, but is different from company founder, early stage employee, entrepreneur, where what you're doing is you are, rolling the dice that have your hours and days and weeks and years on them in the hopes that they will come up with a number that delivers something. And it's not clear that's a better economic choice. It's just a choice that some of us make. And it's important to know whether that's the kind of choice you want to be making over and over again in the face of high likelihood of failure. Questions? Dive when ready.
That was excellent.
Okay, thanks.
We should open it to any questions.
Sure. Anybody?
You can do agile project management too?
I'm on the product management side of Agile. I chaired the last couple of years of the Agile track at the product track at the Agile conferences. Most product managers don't understand or believe in Agile, and most
summarize it.
Sure. So Agile's basically if you apply incremental process improvement to software manufacturing, software writing. It's a whole set of techniques so that engineers, developers can write better software faster by doing it in much smaller chunks. And it's overtaking the software world, and everybody who's doing really good software engineering is either doing Agile or thinking about Agile. The blind spot in Agile is that the same engineers who can't do marketing because they're engineers and can't do product management because they're engineers and don't think those things are hard because they're engineers believe that you don't actually need product management because it's not hard, and that you don't need long-term strategy and pricing and architecture and whatever because your engineers who are really smart will discover week by week what a good product looks like. And that's actually a good strategy in the sort of pure consumer game space. If you were throwing up Facebook games every week and you could throw away all the ones that didn't work, that's okay. If you were building the Federal Reserve's system for managing money in the US, you'd really like to have a plan, an architecture, a user interface design, a strategy in place before you hired those first 400 engineers, right? So I sit at the intersection of people who believe they can build software faster, and they can, but don't want to plan, and people who believe that planning is the only thing that's important because software folks don't matter, and ignore Agile. Short version, I got a lot of stuff written on my site if you want to read it, but it's a case of two communities that don't talk to each other and have sort of mutually exclusive language, and it's a mess. Sorry, I'm off on a tangent. Anybody? Okay, I think everybody needs a break, huh? Thanks.